I believe.
Yeah, thank you, Mr. Chairman. I apologize about not being physically with you all. I just had a couple of quick questions. Um, you know, it feels to me like a lot of the energy around the FDIC insurance reform has kind of dissipated a little bit. I'm not, and I know uh, that the vast majority of interest has come from mid-sized banks. I'd like to hear from the panel if this has already been asked. I apologize, Mr. Chairman, but is there? I'll get it all into one question. One, is there any kind of reform system that benefits all institutions from the very small to the large? And I don't know how you could do that without some additional burden sharing. That's point one. Point two is I continue to believe that better use of the Fed discount window, that's what it was set up for. But is there a way that we could encourage more usage of that didn't carry with it a mark of shame in terms of policy? And then three, I am familiar with the fact that there are a number of these informal exchanges where someone can affect leverage off some of their deposit insurance to kind of go above the 250,000 level. I know there's some informal associations across Virginia. Are there ways to even strengthen that tool? So the panel, any way to do this that benefits the whole community without undue burdens? Two, how do we deal with the discount window in a way that doesn't carry the burden of shame? And three, again, apologies if this question's been asked, how do we do these informal networks that already exist that able to raise the 250 level on a more informal basis?
Well, as a banking practitioner, Senator, I'll take first crack at the last two parts of your question regarding informal exchanges and liquidity facilities that are made available to through the Federal Reserve and through other sources. On the informal exchange piece, bankers are creative. Bankers will swap those deposits overnight so that customers can remain protected. There's a little bit of a cost in doing that. We have to think through if we become more reliant upon that. It's not an automatic item. It takes a registration. It takes a process to do it. But those facilities are used by bankers and regulators.
Isn't that also, that doesn't burden the overall system? People can opt in or opt out of using that tool, right?
That's correct. It doesn't burden the system, and it's understood, and it's generally considered to be a safe practice. Regarding the availability of liquidity tools in preventing a crisis, I think removing stigma, is an important thing. I think the current Federal Reserve facility that came up after the SVB crisis has been useful. It's helped banks that had securities that are high quality assets. It's helped them monetize them or at least be able to use them in the near term. That, I think, is also helping affect a little bit less reluctance or shame in using the discount window. And frankly, many banks don't use the discount window. And I've never known a regulator, at least in the community bank space, to think about that in a challenging way or in a difficult way. I think FDIC already has more powerful tools, prompt corrective action, to address banks that are having concerns, and nobody wants to be in that PCA space.
Thank you. Others on the panel?
Yeah, I'll add to that. On the discount window point, you're exactly right. The Fed should not have to use 13.3 to provide liquidity for a banking run. This has been a problem really since the Fed's creation, and arguably the Fed had the discount window in place and more active. You might have not even seen the establishment of the FDIC during the Great Depression. So I think this is something that deserves a real serious look. As you know, Senator, there were some changes made during the Dodd-Frank Act about the transparency around the 13.3, and that has kind of added more to, I think, bankers' reluctance to use it. In addition, supervisors have historically very much disfavored it. So I think there's some balancing that readjustments that need to be done on the supervisory process to make it bankers feel that, particularly if they are seeing immediate liquidity needs, and again, these are healthy banks that are simply just dealing with a unexpected liquidity shock, that the discount window is there. Frankly,
I'd just interrupt. I'd say I know my time's expired. I do think we ought to consider some of these things because when you've got an SVB type run of, in effect, 40 cents on every dollar, internet driven, no capital constraints are going to be enough. But thank you, Mr. Chairman. Again, my apologies for having to do this from the office.
Thanks, Senator Warner. Senator Cortez Masto of Nevada.
Thank you, Mr. Chairman. Thank